The next learning objective is to describe bonds payable. Large companies need large amounts of money to finance operations. They may borrow long-term from banks or issue bonds payable to the public to raise the money. Bonds payable are groups of long-term notes payable issued to multiple lenders called bondholders. By issuing bonds payable, a company can borrow millions of dollars from thousands of investors rather than depending on a loan from one single bank or lender. Each investor can buy a specified amount of bonds. Each bondholder gets a bond certificate which shows the name of the company that borrowed the money, exactly like a note payable. The certificate states the principal, which is the amount the company has borrowed. The bond's principal amount is also called maturity value or par value. The company must then pay each bondholder the principal amount at a specific future date called the maturity date. People buy bonds to earn interest. The bond certificate states the interest rate that the company will pay and the dates the interest is due, generally semi-annually, which means twice a year. Unlike mortgages, principal is not paid monthly. Instead, it is only paid back when the bond matures. Now, bond terminology is important to understand. Principal amount, also called maturity value or par value, is the amount the borrower must pay back to the bondholders on the maturity date. Maturity date, the date on which the borrower must pay the principal amount to the bondholders. Stated interest rate, the annual rate of interest that the borrower pays the bondholders. Remember, bonds pay interest twice a year. So if a bond's stated interest rate is 8%, it will pay 4% twice a year. This is the image of a bond certificate. The issuer is Smart Touch Learning. That means they are the ones borrowing the money. The bondholder is the person lending the money. The annual stated interest rate in this case is 9%. This does not change. The maturity date is January 1st, 2020. The principal amount is $1,000. That means that Smart Touch Learning must pay the bondholder $1,000 per bond that the bondholder owns. Now, this is assuming Smart Touch Learning is still in business at the maturity date. If not, the bondholder may not receive the $1,000 per bond. Even though each bond will pay $1,000 at maturity, notice this bond certificate states $5,000 at the top. That means this bond certificate consists of 5 $1,000 bonds. A bond can be issued at any price agreed upon by the issuer and the bondholders. There are 3 basic categories of bond prices. A bond can be issued at maturity value, also known as par value. For example, a $1,000 bond is issued for exactly $1,000. A bond issued at par has no discount or premium. Now, bonds being issued at par is kind of rare. Bonds can also be issued at a discount, which means the buyer of the bond paid less than $1,000 for the bond with a $1,000 maturity value. For example, a $1,000 bond is issued for $980. That means the bondholder only paid $980 for a bond that, when it matures, will pay $1,000. In addition, the bondholder receives interest every 6 months until the bond matures. In this example, the discount is $20, the $1,000 maturity value minus $980. One reason a bond could sell at a discount is because it is paying a lower rate of interest compared to similar bonds. So in other words, to entice someone to buy the bond that has a poor interest rate, the price had to be lowered. Bonds can also be issued at a premium, a price above maturity or par value. For example, a $1,000 bond could be issued, which means sold, for $1,015. The premium is $15, $1,015 that it was sold for minus the maturity value of $1,000. In this case, the bondholder paid $15 above maturity value, probably because the bond was selling at an interest rate higher than similar bonds. Even though the bondholder paid $1,015, though, they still only receive $1,000 when the bond matures. Of course, they also receive interest every 6 months. So in this case, they paid $15 extra up front to get that higher interest rate. The issue price of a bond does not affect the required payment at maturity. In all the cases on this slide, the company must pay the maturity value, $1,000 per bond when they mature. Now, bond prices are quoted as a percentage of maturity value. For example, a $1,000 bond quoted at $100 is bought or sold for 100% of maturity value, 1,000 times 100%, or 1,000 times 1. A $1,000 bond quoted at 101.5 has a price of $1,015. To calculate that, you take the $1,000 times the price, which remember is a percentage, so 1,000 times 101.5%, or 1,000 times 1.015. A $1,000 bond quoted at 89.75 has a price of $897.50. To calculate that, it's $1,000 maturity value times 89.75%, or 1,000 times 0.8975. The issue price of a bond determines the amount of cash the company receives when it issues the bond. In all cases, the company must pay the bond's maturity value to retire it at maturity. A bondholder doesn't have to hold the bond until it matures. The bondholder may sell it to other investors. Let's say you have a bond paying 8%, and then interest rates fall to 5%. So they've gone from 8% to 5%. That means new bonds being sold are only paying 5%. Suddenly, other investors are very interested in buying your 8% bond, so much so that they will pay a premium for your bond. Once issued, bond prices can fluctuate daily like stock prices as investors buy and sell the bonds amongst each other. Now let's review the bond facts before we get to the homework. The company selling the corporate bond is the borrower. That means the person buying the bond, called the bondholder, is the lender. Each bond could sell for more or less than $1,000, even though at maturity value it has to pay the $1,000. For example, if a bond sells for $950, this bond sold at a $50 discount. If a bond sells for $1,025, the bond sold at a $25 premium. Now, for the right to borrow the money, the company will pay interest every 6 months, and the maturity value, $1,000 per bond, when the bond matures, even if the bond sold for more than $1,000.